Imagine you check your brokerage app first thing in the morning before coffee, before anything else. The market opened red. Your portfolio is down 4%. Your stomach drops. You tell yourself to stay calm, but by noon you've sold 2 positions because someone on Reddit said the bottom hasn't come yet, and that same guy was right last month, so maybe he's right again. By Friday, the stocks you sold are up 8%. Sound familiar? Here is the uncomfortable truth most people never want to face. The way the majority of Americans interact with the stock market has almost nothing to do with investing. It looks like investing. It feels like investing. But underneath, it is something else entirely. It is closer to gambling with extra steps, and the house always wins in that version of the game. The difference between someone who builds real, lasting wealth in the market and someone who just churns through losses and lucky streaks, that difference is not intelligence. It is not timing. It is not even access to the right information. It is a completely different way of thinking about what the market actually is and what your relationship to it should be. That is exactly what Benjamin Graham spent his entire career trying to teach, and he packed the most important version of that lesson into one book published in 1949, revised multiple times, and still considered by Warren Buffett himself to be the best book about investing ever written. The book is called The Intelligent Investor. And before you assume this is just old advice that doesn't apply anymore, stay with me, because the core ideas in this book are not about stocks from 70 years ago. They are about human behavior, and human behavior has not changed one bit. Graham was a Columbia professor, a Wall Street legend, and the man who personally mentored Warren Buffett when Buffett was still a student trying to figure out how money actually worked. Graham didn't just study the market, he survived it. He lived through the crash of 1929, rebuilt, and came out on the other side with a framework so solid that it has outlasted every market trend, every bubble, and every financial crisis since. The central idea of this book is deceptively simple. The market is not a truth-telling machine. It is a voting machine in the short run, driven by fear and greed, and a weighing machine in the long run, driven by actual business value. Your job as an investor is not to follow the vote. It is to understand the weight. And there is one idea in this book, a single metaphor Graham invented, that once you hear it, you will never look at a down market the same way again. We will get there. But first, let's build the foundation. If ideas like these make you think differently about money, subscribe. This is exactly what we do here, every single week. Let's start with the distinction that changes everything, the one Graham draws right at the beginning of the book, and the one that most people skip over because it sounds too simple to matter. The difference between an investor and a speculator. On the surface, they look identical. Both of them open brokerage accounts, both of them buy stocks, both of them check prices and read headlines. But the way they think, the reason they make each decision, could not be more different. A speculator buys a stock because they believe the price is going to go up soon. That's it. They're betting on the direction of the market, on momentum, on what other people are going to do next. An investor, in Graham's definition, buys a piece of a real business at a price they've analyzed carefully with the expectation that the business will generate value over time. One of them is playing the crowd. The other is ignoring the crowd entirely and focusing on something more durable, the actual company behind the ticker symbol. Think about the last time you bought a stock or thought about buying one. Were you thinking about the company's earnings, its debt levels, its competitive position in the market? Or were you thinking about what the chart looked like, what someone online said, or the fact that it had already gone up 30% and you didn't want to miss out? There is no judgment here. Most people, if they're honest, are closer to speculator than investor. Graham wasn't trying to shame anyone. He was trying to hand people a map they didn't know they were missing. And the next idea in that map is probably the most important concept in the entire book. Graham called it the margin of safety, and once you understand it, you will see it everywhere, not just in investing, but in how smart people make decisions in general. Here is the idea. Never buy something for what it is worth. Only buy it for significantly less than what it is worth. That gap between what you pay and what it's actually worth, that is your margin of safety. It is your cushion against being wrong, and you will be wrong sometimes. Every investor is. The margin of safety is what keeps a mistake from becoming a disaster. Graham used to explain it this way. When engineers design a bridge meant to hold 10,000 pounds, they don't build it to hold exactly 10,000 pounds. They build it to hold 50,000. Not because they expect that weight, but because they know the real world is full of surprises, unexpected stress, design flaws, bad weather, things nobody planned for. Investing works the same way. When you only buy a stock at a price well below its true value, you are building in protection. The company doesn't have to be perfect. The economy doesn't have to cooperate. You've already accounted for the unexpected by not overpaying in the first place. This is the exact opposite of how most people buy stocks. Most people buy after a stock has gone up when confidence is high and prices are high, which means the margin of safety is basically zero. They are paying full price or above it and hoping everything goes right. Graham spent decades watching that approach destroy people's savings, and he never stopped believing there was a better way. Now, here is where it gets a little more philosophical, but stay with me, because this next idea is what separates investors who truly understand the market from everyone else. Graham made a distinction that sounds almost obvious until you sit with it. The price of a stock and the value of a stock are two completely different things. Price is what the market says right now, in this moment, driven by sentiment, news, fear, momentum, and 1,000 other forces that have nothing to do with how good the underlying business actually is. Value is something more fundamental. It is what the business is genuinely worth, based on its earnings, its assets, its prospects, its position in the. Here is a real scenario that happens constantly. A company releases a quarterly earnings report. The numbers are good, but slightly below what analysts predicted. The stock drops 20% in a single day. Did the business get 20% worse overnight? Did its products stop working? Did its customers disappear? Almost certainly not. The price changed dramatically. The value most likely barely moved. And that gap, that irrational disconnect between price and value, is exactly where the intelligent investor finds opportunity, while everyone else is running for the exit. Graham understood that people are wired to react emotionally to price movements, and he didn't pretend that instinct could be fully erased. What he did instead was give investors a practical structure to work within, depending on how much time and energy they were genuinely willing to put into their portfolio. He called this the distinction between the defensive investor and the enterprising investor, and it is important to understand that neither one is better. They are just honest about different things. The defensive investor is someone with a full life, a job, a family, obligations, priorities that have nothing to do with finance. This person does not want to spend weekends analyzing balance sheets, and Graham respects that completely. The strategy for this person is built around simplicity, a diversified mix of high-quality stocks and bonds, bought at reasonable prices, held patiently, and rebalanced occasionally. No trading, no timing the market, no reacting to news cycles, just consistency over time through all the ups and downs. Graham believed this approach, done correctly and with discipline, would outperform the vast majority of active traders and professional fund managers, and decades of data have proven him right. The enterprising investor, on the other hand, is someone willing to treat investing as a serious part-time job, not out of obsession, but out of genuine interest and commitment. This person does their own research, digs into financial statements, looks for companies the market has mispriced, and builds a portfolio of carefully selected individual businesses. Graham was not saying this person is smarter. He was saying this person has made a real decision about where they want to invest their time, and they follow through on that decision with discipline and rigor. The key word in both cases is discipline. Graham had no interest in casual approaches to either path. This matters enormously in 2026 because the options available to a defensive investor today are better than anything Graham could have imagined. Low-cost index funds, fractional shares, automatic rebalancing tools, all of it makes the defensive strategy more accessible than ever. And yet, paradoxically, the noise has never been louder. Social media, financial influencers, real-time market alerts, crypto cycles, meme stocks, all of it pulls even the most disciplined person towards speculation. Graham's framework is not just useful right now, it might be more necessary right now than at any other point in history. Here is the idea that might feel the most counterintuitive, the one that trips up even experienced investors. You would think that the best stocks to own are the ones from the best, fastest-growing companies. The ones everyone knows are going to dominate their industries, the ones that are obviously, undeniably great businesses. And in terms of business quality, you might be right. But Graham would push back hard on the investment logic, because when a company is universally recognized as great, that recognition is already priced in. Everyone already knows it's great, which means everyone already wants to own it, which means you're almost certainly overpaying for it. Think about what happened with the wave of artificial intelligence companies between 2023 and 2025. Incredible businesses, real technology, real revenue, real futures. And yet many investors who bought in at peak enthusiasm watched their positions stagnate or fall, not because the companies failed, but because the price they paid had already assumed 10 years of perfect execution. There was no margin of safety. There was no room for any disappointment. Graham saw this pattern repeat across decades, with railroads, with radio companies, with airlines, with dot-coms, and he kept saying the same thing. A great company and a great investment are not the same thing. Price matters, always. And then comes the insight that pulls all of this together, the one that lives at the heart of the book and the one that Warren Buffett has said changed his entire life. Graham asked you to imagine that you own a share in a small private business, and you have a partner in that business named Mr. Market. Every single day, Mr. Market shows up at your door and offers to either buy your share or sell you his, at whatever price he feels like that morning. Some days, Mr. Market is wildly optimistic. The business is the same as it was yesterday, but he is in a great mood and he offers you a very high price. Other days, Mr. Market is terrified. Nothing has changed in the actual business, but he is convinced disaster is coming, and he offers you his share for almost nothing. Here is the question Graham wants you to sit with. What kind of person lets Mr. Market's mood determine whether they feel rich or poor? What kind of person panics when Mr. Market panics, or gets greedy when Mr. Market gets greedy, as if his emotional state is somehow more accurate than their own careful analysis of the business? The market is not your advisor. It is not a signal. It is not a truth. It is just an offer. You can take it, or you can ignore it and come back tomorrow when the offer might be completely different. The intelligent investor does not follow Mr. Market. The intelligent investor uses Mr. Market patiently, selectively, only when the offer makes sense. That shift from seeing the market as something to react to seeing it as something to occasionally take advantage of, that is the transformation Graham is offering you. And once you see it that way, a dropping market stops feeling like a threat and starts feeling like a sale. There is one more thing Graham wanted every investor to understand, and it is perhaps the most honest thing in the entire book. He never promised that applying these principles would be easy. He never said discipline was simple, or that watching your portfolio drop 30% while telling yourself this is just Mr. Market having a bad day would feel comfortable. It won't. It will feel terrible, and that is exactly the point. Graham believed with everything he had seen across decades on Wall Street that the single greatest enemy of the intelligent investor is not a bad economy, not rising interest rates, not inflation, not even poor stock selection. The greatest enemy is the investor themselves, their own impatience, their own need to feel like they are doing something, their own inability to sit still while the crowd runs in one direction, screaming that the world is ending or that this particular stock is going to make everyone rich. He wrote that the investor's chief problem, and even his worst enemy, is likely to be himself. And that sentence, written more than 70 years ago, describes the average retail investor in 2026 with frightening precision. Because what has changed since 1949 is not human nature. What has changed is the volume and the speed of everything around us. The news cycle moves in seconds now. Your portfolio is visible at all times on a device that never leaves your hand. Every market movement comes with a dozen hot takes, urgent alerts, and confident predictions from people who will never be held accountable for being wrong. All of that noise is designed, whether intentionally or not, to make you react, to make you feel like doing nothing is irresponsible, to make patience feel like passivity. Graham would look at the modern financial media landscape and recognize it immediately. It is Mr. Market, amplified, digitized, and delivered directly to your nervous system 24 hours a day, 7 days a week. The antidote is not to disconnect from the world. It is to build, in your own mind, a framework so clear and so grounded that the noise simply loses its power over you. That is what this book actually gives you, not a formula, not a stock-picking system, not a guaranteed path to wealth. What Graham gives you is a way of thinking, a set of principles sturdy enough to hold up under any market condition in any decade, against any emotional storm the market throws at you. And that is rarer and more valuable than any hot tip or trading strategy you will ever come across. So here is where you stand now, having spent this time with these ideas. Before this book, the market probably felt like something you had to keep up with, something that rewarded the quick and punished the slow, something that required you to be constantly watching, constantly reacting, constantly making decisions. That version of the market is exhausting, and it is also largely fictional. It is Mr. Market's version, the frantic, emotional, irrational version, and it has nothing to do with building real, lasting wealth. After this book, the market looks different. It is a place where businesses are bought and sold every day, often at prices that have very little to do with their actual worth. It is a place where patience is the rarest and most rewarded quality. It is a place where your greatest advantage is not information or intelligence or access, but temperament. The ability to stay calm when others panic. The ability to buy when others sell. The ability to ignore Mr. Market when his offer doesn't make sense. And to walk calmly back inside and wait for a better one tomorrow. This summary gives you the architecture of Graham's thinking, but the book itself gives you something a summary never can: the full weight of his reasoning, the historical examples he walked through, crisis by crisis, the specific criteria he used to evaluate stocks, the formulas, the case studies, the texture of his thinking across hundreds of pages. Some books deserve to be read slowly, in your own hands with a pen nearby. This is one of them. The link to grab your own copy is in the comments below. And here's the thought to carry with you after this video ends. Every time you feel the urge to make a financial decision based on fear or excitement, or the sense that everyone else seems to know something you don't. Ask yourself one simple question: am I responding to Mr. Market right now, or am I thinking for myself? The answer to that question, made consistently over years and decades, is the difference between the investor who builds something real and the one who just got lucky a few times before the luck ran out.